This is the beginning of part 2 of our module entitled FX Options Greeks, which examines in a formal way the factor sensitivities of FX options, often known as the Greeks because they are usually denoted with Greek letters by quantitative analysts. We remind you that this part 2 contains chapters 3 and 4, with chapter 3 illustrating in detail the exact process of delta hedging an option until its expiration date, and chapter 4 defining gamma and examining its factor sensitivities, particularly to changes in spot and in the option's remaining tenor. This chapter 3 provides a complete illustration of delta hedging and its economics, which takes into account all inputs in the pricing model and seeks to demonstrate how views held by the trader on future volatility, provided they differ from market expectations, can earn profits for the trader. This worksheet, Delta Hedging 1, involves a 3-month, please note, 3-month sterling call, whose terms are otherwise the same as before. Our model will show each step of the delta hedging exercise, assuming, as you can see in column B, daily rebalancing. And the model allows you to simulate, in column E, any price movement in the sterling dollar rate consistent with the assumption we mentioned a minute ago regarding the returns being normally distributed. We begin in cell E5 with a spot value for sterling of 1.5 and then simulate the path of the currency over the next 90 days. By now you must have realized, obviously, that we have hidden rows 8 to 92 simply to preserve space. We also specify for Excel that we would like a daily volatility in the simulation of 0.5% in this particular instance, appearing in cell D97. The way we implement the simulation on Excel is by means of an operator that allows you to specify first that the numbers which will appear in column D, appropriately labeled random number, must be randomly generated by Excel, but must satisfy the key property of being normally distributed, and specifically to have a mean of 0 and a standard deviation of 1 unit, which you may recall are precisely the defining parameters of what is called a standardized normal distribution. The generation of these random numbers for column D proceeds as follows. Hit Tools on the menu bar, then go down to Data Analysis. Specify among all these alternatives you see here that you're interested in a random number generation process, and hit OK. Further, Excel now gives you a choice among the different types of distributions you're interested in, including, for example, a binomial, a Poisson, a Bernoulli distribution, and, gladly, the normal distribution, which we specify. Automatically, Excel knows that the mean of such a distribution is 0 and the standard deviation is 1. And finally, since we have already done this ourselves, you will note that we're instructing Excel down here to type in all these randomly generated numbers in cells D6 to D95, which you'll see in a moment are exactly the right cells corresponding to the day-to-day changes of the sterling. So we now hit OK. And here appear the randomly generated numbers. Unfortunately, Excel does not preserve the format with this one particular function of the rest of the worksheet. So we'll take the trouble to go ahead and ask Excel to reformat those numbers, those cells, so that they look exactly the same in formatting terms as the cells further to the right, including the font and the use of 4 decimal places. We may not be able to prove to you that the numbers generated in column D, and there will be some 90 numbers if you unhide the rows, are correctly randomly generated and satisfy a normal distribution, but you can certainly do one quick test and check whether, consistent with a standardized normal distribution, some 68% of the numbers that were generated lie exactly between +1 and -1, somewhere in between within this range of plus or minus 1 standard deviation. And as a second check, that some 95% of them lie between +2 and -2, properties that should ring a bell regarding a normal distribution. If you do this, you may find some marginal variations, trial by trial, up and down from the correct numbers, but nothing particularly disturbing. Now, if you wish to try a second time to generate these numbers randomly, you repeat the same process: Tools, Data Analysis, Random Number Generation, hit OK, and you will get the same dialog box you had a minute ago. So all you have to do this time is hit OK without need for further inputs. In a second, when we do that, you will see Excel asking us whether we wish to save the previous set of numbers or not, and we will instruct it, no, just go ahead and overwrite the previous numbers and insert the new numbers. Here is the question, you can only see half of it, and here is the OK, and here are new randomly generated numbers, which unfortunately once again need to be reformatted if you're a stickler for these kinds of details. Next in this worksheet, column E plots the path of sterling consistent with the numbers randomly generated in column D. It does this simply by, as you can see here, multiplying the previous day's spot of 1.5 in cell E5 by 1 plus the daily volatility, hence the reference in the formula to cell D97, multiplied by the randomly generated number immediately to the left in cell D6, corresponding to that day. In effect, you are asking Excel to take the previous price, in this case 1.5, and push it either up or down, depending on the random number, by an amount based on that randomly generated number for the row you're immediately standing on, but also consistent with the assumed daily volatility in cell D97 of 0.5% in this case. Since the worksheet is based on only a total of 91 days, starting at day 0 and finishing day 90, the actual time series of spot values that you get in sell E5 to sell E95, those 91 or so values will not necessarily always come out, in fact, to have a daily standard deviation of exactly 0.5, although the result will invariably be quite close. And the average, if you try several dozen simulations, should certainly turn out to be very close indeed to 0.5. The actual or realized daily vol of the time series of spot prices that we just generated in column E appears, as you can see, in this cell M97, and the calculation here of the realized vol is based on the exact formula for defining volatility that you see programmed in the cell, specifically the standard deviation of a bunch of numbers in hidden column F. But if you open the hidden column F, you will see all it does is it takes the logarithms, in essence, of the numbers in column E. Next, cell M98 converts this daily volatility, which came out to be 0.50 to 2 decimal places of accuracy, into an annualized volatility. And it does this by multiplying the daily volatility by, as you can see, the square root of 365. Please note, you do not put square root of 90 or 91 here. The tenor of the option may be 90 or 91 days, but the process of converting a vol of 1 day into a vol of 1 year requires multiplying by the square root of the total number of days in 1 year, or 365. Note that our spreadsheet assumes, and this formula specifically assumes, that every day is a business day or a trading day, which many times is not true. And of course you can adjust this to reflect business days instead of calendar days. So many textbooks talk about a year of 252 trading days, which is perhaps closer to reality. Lastly, on this spreadsheet or worksheet, you see column L, very importantly, which has the delta of the option as of that day. And next to it, column M converts the numbers in column L into the required size of the delta hedge in sterling, simply, of course, by multiplying the delta number in column L by the 1 million sterling notional, as we saw previously. We now turn to worksheet delta hedging 2, and more specifically to columns L, M, N, O, and P, where the real nuts and bolts of the delta hedging exercise are illustrated step by step. To make our lives easier, we have assumed, as before, that the two yield curves are flat at 5% and that they remain this way during the life of the option. The benefit of this, of course, is that this allows us also to assume that the forward is always equal to the spot, but the worksheet would work just as well if you loosened this assumption. The second convenient consequence of this assumption is that we can delta hedge using only forward contracts instead of borrowing in one currency, investing in the other, and monitoring our cost of carry that results from this, i.e. the difference between the borrowing rate and the investing rate, which would then require many more calculations and columns. Starting then on row 6 with a spot of 1.5 exactly, cell L6, which contains the formula for delta, tells us quite simply that delta at that time is 0.5032. Not surprising, since we're exactly at the money spot and forward. The trader therefore enters into a forward contract at the forward rate, which is 1.5, for settlement 91 days later. Perhaps as a point of clarification, we should explain, when we use the reference here in cell B6 to day 0, we mean on the morning, if you like, of the beginning of this exercise. So the trader walks into the office, immediately sells the call option, and immediately sets up a delta hedge. And therefore, 91 days later would include that initial day 0, and therefore would actually be referred to, as we have done here, as day 90. Just a matter of clarification. Now, knowing that the delta is 0.5032, the trader, as we have said, enters a forward contract at this 1.50 forward rate for settlement 91 days later. And therefore, the forward contract in question would have a sterling notional, as you can see in cell N6, of 503,201 pounds. The trader is therefore going long this amount of sterling, but in the forward market, and short an amount appearing in cell 06 and equal to 754,802 dollars, which very simply corresponds to the sterling notional of the forward contract multiplied by the forward of 1.5 prevailing on that date. Let's now move to the next day on row 7, where the simulation, because of a very small positive randomly generated number, this 0.0887, the simulation has pushed the spot up just a little bit to 1.5007, and remember, with it the forward as well. Our delta appearing in M7 would, of course, and has increased a little bit to 0.5069, beg your pardon, L7, so that today my total delta hedge would require me to be in aggregate long 506,902 sterling, which means having to increase the long sterling position in the forward market by this 3,701, calculated, as you can see, as simply the difference between the new requirement minus the old requirement, M7 minus N6. To do this, the trader once again buys sterling forward, but this time under a forward contract settling in 90 days instead of 91 days, i.e. on the same date as the previous forward contract, and matching, of course, the expiration of the option. In going long 3,701 pounds, the trader is going short in dollars in the forward market, an amount equal to that sterling notional times, careful now, the new forward rate of 1.5007. And this amount turns out to be $5,554. In effect, he is increasing his delta to the new appropriate amount that was dictated by the calculation. this process continues until the expiration date of the option in the last row. And we know that on that day, the option will expire either in the money or out of the money. On this particular occasion, this particular simulation, having pulled the spot down all the way to 136, of course, our option would be expiring, being a call option, out of the money. We know also that the delta, since the option has to end up either in the money or out of the money, the delta on the last day has to be and is either 0 or 1. In this particular case, 0. So under scenario 1, which appears on a worksheet called scenario 1, the option appears to have ended after another randomly generated number process. This option, in this case, appears to have expired in the money, spot being above the strike. And as we can see, its delta has reached virtually 1. So the trader ends up on this last day with just a few hours left when he does the last rebalancing on the morning of that day, shall we say, long almost exactly 1 million sterling. But of course, the trader is also short the amount indicated in cell P96 of $1.526 million. An amount, it can be shown mathematically, that is certain to exceed 1.5 million dollars. Next, the option, of course, will be exercised by the holder. The trader will be required to deliver the 1 million or so sterling that he already has. The trader will receive $1.5 million from the option holder, and the trader therefore can cover almost all of the 1.526 million short dollar position, with the remaining uncovered amount being his final loss from the delta hedging process. You should be able to quickly confirm that this remaining uncovered amount is $26,395. Next, we show scenario 2 on worksheet scenario 2. Here the option expires out of the money, as you can see, with the final spot at roughly 136. The delta of the option is 0. So the trader has ended up on the last day having gradually reduced his sterling position, shown here, all the way down to 0. But he still has a negative US dollar balance indicated in cell P95 on this spreadsheet. The option lapses, i.e. does not get exercised. The trader does not need to deliver any sterling, which he does not have anyway, and therefore the trader has incurred a loss once again from the delta hedging process equal to $27,360, the amount indicated in this cell P95. The key question, therefore, is whether the premium the trader charged for selling the option covers the losses he has incurred from the delta hedging process under these two alternative scenarios. Back to worksheet GK. The worksheet enables us to calculate the premium the trader would have charged based on the volatility that we will input in cell F9, and where we have already, you will note, specified the correct tenor of 1/4 of a year, i.e. roughly 90 days. If the trader expected, as we said before, that daily daily expected volatility to be 0.5%, since the model requires in here in cell F9 that you input the annualized volatility, you therefore have to type in here equals 0.5% times the square root of 365. Of course, you can calculate that in a separate cell and just type it in here manually. Hit OK, and we find a premium of 2 cents 82 per pound, which becomes $28,200 for the entire option. This number compares with actual losses from the delta hedging exercise, which we remind you were 26,395 in scenario 1 and 27,360 in scenario 2. So the premium has just about covered the trader's losses from delta hedging. If you try this process again a few times, you may get some small amount of slippage, which would be due to two factors. One, the trader's expectation of a daily vol of 0.5 might differ from the actual daily vol that we calculate ex post facto, i.e. after the fact. Let's illustrate. You will note in this particular example that we saw earlier for scenario 1, the trader expected a vol of 0.5 and proceeded to price the option on the assumption, therefore, of an annualized expected vol, shall we say, of 9.55%, or 10%, or whatever, but the actual realized vol that Excel generated from its process was very slightly lower in this case, 0.47% daily and 9.04% annualized. If you try this several times in a row, you will have numbers appearing in these two cells here in column O that will occasionally lie below and occasionally lie slightly above the expectations of the trader in cells E99 and E100. The second reason for a small difference that may arise between the actual losses of the delta hedging process and the premium charged relate quite simply to the fact that the premium is received up front, while the losses have been calculated as of the expiration date, which is 3 months later. There is therefore a small time value of money adjustment that you would technically need to do. Let's make a number of observations about this delta hedging process. First, even if the option is only very slightly in the money at expiration, its delta will have gradually increased towards 1 as it approached expiration. So the trader will be certain to be long the exact amount of sterling at expiration that he will need to deliver when the option is exercised. If he followed the delta hedging process meticulously, he has no risk of having an uncovered short call position at expiration, although sudden swings in the spot right before maturity could still cause him some pain, as we will see later. Point 2. By the same token, even if the option is only slightly out of the money at expiration, its delta will have gradually decreased towards 0 as it approached expiration, as the option approached expiration. So the trader will be certain to have completely liquidated, i.e. sold down, his sterling position by that expiration date, and will not own any sterling that he no longer needs, since the out-of-the-money option will not be exercised. Once again, if he followed the delta hedging process meticulously, i.e. very precisely, he has no risk of having an unnecessary long sterling position at expiration, although once again, sudden swings in the spot right before maturity could still cause him some pain, as we will show later. Point 3. A trader may delta hedge an option up to a certain date, then decide that market conditions have changed in such a manner that he is better off covering his position with another option and terminating the delta hedging process instead of continuing it. We illustrate this idea on this worksheet, Delta Hedging 3, by taking the case of the 91-day sterling call once again, and assuming that the trader expects daily vol to be 0.5%, while the market is willing to price options under Garmin-Kohlhagen on the view of a daily vol of 0.75%, so 25 basis points higher of daily volatility. This difference in opinions has been exaggerated versus reality for the clarity of the teaching point. So turning once again to worksheet GK to price the option, the trader would input 0.25 for the tenor and is allowed, if you like, by the market to assume a daily vol of 75 basis points, therefore an annualized vol of 75 basis points times the square root of 365, so 14.33%, which leads to a premium that you can see here per pound of $0.0423, and which becomes $42,300 based on the notional of 1 million pounds. Now the trader proceeds to delta hedge this option for, let's say, the first month, so for the first 30 or 31 days. And daily vol turns out, and we designed the random number generation deliberately to do this, daily vol turns out to be, in this example, way below 0.75, and in fact much closer to the 0.5% that the dealer had anticipated. The worksheet shows the trader's position as it has evolved during those first 30 or 31 days. As row 35 shows, by the very beginning of what we are calling day 30, and with spot having reached, as it turns out, 145.11, the trader is long sterling forward in an amount equal to 201,000 pounds 570, and short an amount in dollars equal to 313,133 for delivery in roughly 60 days. Assume furthermore that because the realized vol over these last 30 days has turned out to be only 0.42% daily, as indicated in the cell 038, the market has recognized the error of its ways, so to speak, and is now prepared to price sterling dollar short-dated options at an implied daily volatility of 0.5%, instead of the previous 0.75%, which translates into an annualized volatility, as we know, of 9.55%. The trader might decide to close out his option and his forward position entirely, which are described in the left column here, by taking the actions appearing next on this slide. First, the trader would purchase a 2-month call on sterling struck at 1.5 to offset his short call position. And this would cost him only $6,275, it turns out, given the shortened tenor and the drop in spot, which has now put this option out of the money and therefore made it cheaper. Trader would also sell sterling 201,570 notional amount for delivery in 2 months at the current forward price of 1.4511, and therefore against receipt of $292,488 for delivery on the same date. The last column of this table can now be devised to show the net position for the trader after these actions, with the option and the sterling legs being completely square, i.e. neutralizing each other, the cash position having been depleted, but only from 42,000 on the left at the bottom to 36,000 at the bottom right, and then in the row immediately above that, the trader continuing to be short dollars in the forward market, but for an amount of only 20,645. So even if we ignore the time value of money, the trader has locked in a gain equal to the difference between the two numbers appearing in the last column, which is roughly $15,380 as a consequence of this unwind. We leave this discussion of delta hedging with one last illustration of what can go really badly wrong with the process, and this will lead nicely into our final topic in part 1 of this module, gamma. We open worksheet gapping and observe that on the day just prior to expiration, spot stands at 1.4755, which of course puts the option out of the money and its delta very, very close to zero. As explained previously, the very low delta on that day means that the trader would have liquidated, sold, the bulk of his long sterling position by now, and in fact is left with only a long sterling position of 510 sterling, while being short, as you can see here in cell P96, $27,467. Note also that the daily vol has turned out, in fact, to be 0.49%, almost exactly equal to the 0.5% that the trader had assumed in pricing the option up front. If spot remains stable on that day at 1.4755 or moves very little, then at the option's expiration, the option would lapse, i.e. would not get exercised, and the trader will simply close his currency position for a loss net of $26,714 appearing in cell P99, calculated through this rather complex formula here as essentially the net result of liquidating the remaining 510 pounds at the current spot rate of 1.4755 and using those few dollars obtained from this liquidation, this final liquidation, to pay down a portion of the short dollar position in cell P96, leaving, as we said, the trader with a net loss of 26,714. Recall, however, that the trader charged an upfront premium under GK equal to $28,200 and has been able to invest that money at 5% for 3 months, and therefore the trader has more or less broken even once again, exactly as we would expect given the proximity between the realized vol and the expected daily vol. Now assume, however, that on the very last day, just before the option lapses, spot, which was 1.4755 a few hours ago, suddenly jumps to, let's say, 1.5755, a rare but not historically unprecedented movement of 10 cents during the course of a single day. All of a sudden, the call option is quite deeply in the money, and it will be exercised after all. Now the trader is completely naked in that he has to deliver 1 million pounds but does not have them, and so he must purchase almost all of them except the 510 that he already had earlier that morning, and he must purchase those pounds at the current spot market price of 1.5755. Cell P102 on this worksheet shows how this last jump in sterling has taken the trader from a position of more or less breaking even, as we had said, to one where he has a loss of $102,000 or so. Less than 1/3 of this loss being offset by the upfront premium of $28,200. The formula in the cell P102 adds to the loss of 26,714 appearing in cell P99 an additional and large loss, reflecting the fact that 999,490 pounds sterling must be purchased by the trader at the spot price of 1.5755, only to be delivered under the option at a strike price of 1. Essentially, there is a loss of about 7.5 cents per pound. So in aggregate, an incremental loss of some $75,000 between these two scenarios here. There is nothing surprising about a trader losing a great deal of money if he has a large short position in a currency just before it experiences a huge rally. The same would happen with a stock or a commodity. What makes our situation special, however, is that the trader went from being completely square just one day before to being massively short a day later, because the options delta jumped so radically from almost 0 to 1, wreaking havoc with the trader's previously sound hedge. While any call options delta would increase substantially if the spot increased by such a large percentage in such a short time, what made this case so extreme was that the option was very close to the money and had so little time left until expiration. Two factors which, we hinted before, cause its delta to become especially volatile, or stated differently, cause its gamma to become enormous. A trader that is short an option is short gamma, and when gamma becomes so high, abrupt moves in the underlying, known as gaps, become especially painful. This is why the Black-Scholes and GK models work best if prices are assumed to move continuously and the trader is able to transact in any volume at any time without moving the market. This is also why traders hate short option positions so much, especially right before expiration, and why strict gamma limits are imposed on options traders in most cases, especially for illiquid underlying assets, which are more likely to change price abruptly. We will see in a more advanced course what strategies are available to the trader to mitigate short gamma risk and at what cost. By now, the meaning and importance of gamma should have become much clearer, so we will start Chapter 4 by analyzing the properties of gamma in a more formal way. Chapter 3 finishes here.